Hello everyone, welcome to our discussion from Chapter 11 about retirement plans and how they work. So we've kind of moved from individual taxation to business taxation, but retirement plans is kind of a both in that we will discuss how they impact employers or businesses who provide them for their employees, as well as individually sponsored retirement plans and how that affects the individual taxes of those who use those tools. All right. So before we get into the details of the differences between these, we need to understand some of the basic idea behind retirement plans. So the concept is Congress has determined that saving for retirement is a good thing. And so they have tried to put into the tax law various ways to receive tax advantages through savings for retirement. All right. And so that is the basis of these rules, is to encourage savings. Okay. Now we'll also talk about there's some encouragement for saving for education, which are modeled after the rules that already existed. Have it with regard to saving for retirement. So that's because the rules are similar, we'll talk about that as well. So I want you to understand none of these situations are what we would refer to as tax-free. There's nothing that in the tax law that says you will never pay tax on retirement income, but rather that you will have tax deferral. And the idea behind tax deferral is if you pay taxes later rather than now, that later amounts that you pay are worth less. Okay, so paying $1,000 today or $1,000 in the future, when it's payment amounts, you prefer to pay it in the future. Okay, and so that is the one concept. And the other concept that kind of underlied it is that you want to have a tax deduction when you're in a higher tax bracket. And remember that we learned about the progressive nature of the tax law in the United States, in that the more your income, the higher your income, the higher percentage of your income you pay in taxes. So there was the idea behind it was you take a deduction, meaning you lower your taxable income when your tax rate is higher, and when you pull out money from a retirement plan, you will be in a lower tax bracket, and therefore your payment and taxes on that will be a lower tax bracket or less tax than you would have if you'd have gotten that income 20 years earlier. Okay, so that's the idea. It's not that taxation goes away, it's that you pay it later and potentially at a lower rate of tax. We have lots of different categories of retirement plans that are stated in the law. And we have to be careful that these plans, the benefits, the tax savings or deferral or whatever, go away if they're not set up properly, if they're not taken, we don't follow the rules in the law. That's basically the downside of them, is they have to have these restrictions and situations, or they don't achieve the tax benefit that they are supposed to do. So we have employer-sponsored plans that require a business and an employer to actually do something, file paperwork, be part of the process. And then we have those that can be set up by any individual without any involvement by their employer or by a business. Some terminologies, okay? Some buzzwords that are defined in your textbook. Annuity is something that pays out over time. Typically, we consider that to be an equal amount. All right, so that's what we mean by annuity, is it's an equal amount and equal time period in between. So if an investment pays you monthly income and it's the same amount each month, that's an annuity. It sounds like it's talking about annual, but it doesn't have to be annual to be an annuity. It just has to be regular payments on a regular time schedule, usually the same amount. It can adjust each year based on some percentage, but and still be considered an annuity. Beneficiary, okay, is that those who receive the benefits when the owner of something dies, okay, or passes away. The beneficiary steps into that situation. Contributions is putting money into a retirement plan or a savings plan or whatever we're talking about. Distributions is money coming out. The donor is the person putting it in, okay, into the plan, okay. If it's tax deferred, it's sometimes also used the term qualified, which means it has that tax advantage that we talked about earlier, that it fits the requirements. There's a whole bunch of retirement plans that are considered non-qualified, don't achieve tax deferred status, that are done by employers, which allows them to be very creative in some of the things they provide. That is well beyond the scope of this course and not what we're talking about. We're talking about a limited number of those that are typically have a tax deferred status. And then the trustee is a third party, okay, that makes sure that the rules are followed. All right, so the trustee is the one that holds the investments. Now, when we talk about these different plans, none of them are what we would consider a particular investment. They simply are a type of account that then could be invested in lots of different things. You could buy real estate, they could buy stocks, bonds, all of those kinds of things. This no way is a class on investments. This is simply about the types of accounts that you could then utilize the money in to determine those investments, and how those investments can be determined is a whole another set of discussions. For tax purposes, we're not worried about what investments are made. We're simply concerned about following the rules. Now, there is some limit on some investments, but for the most part, we're just worried about the setup of the account and so forth to fit the criteria under the tax law. So once again, tax deferred does not mean tax free. So the general rule is if you put it in and you save taxes now, meaning when you put the money into the plan, it reduces your current taxable income. Then when you take that money out of that plan, you're going to have to pay tax on it. If you didn't receive a tax deduction currently, then typically when you pull it out later on, it will not be taxed. Okay, so it's one or the other. Very little in the way of both, okay, in the tax law, almost none. Now, if done properly, okay, they provide that tax deduction to the person, or if it's employer related or sponsored, to the employer as well for putting money into it. So some of the things you may be familiar with, you may have heard some of these terms, okay, is employer-sponsored retirement plans, okay. There's the qualified, and that's what we're talking, all these are what we call qualified, which means they have that tax deferral. 401ks. 403b is simply a 401k, almost exactly the same rules except for a nonprofit organization versus a for-profit organization. So a regular for-profit business sets up a 401k. A nonprofit, like Hack, for instance, sets up a 403b. If you're self-employed, you can set up a KEO plan. It's a little more complicated than a simplified employee pension, very, as it says, simplified. Okay, these, and then Congress, and you'll dispute their name for it, came along and tried to set up another set of plans that are what we refer to as simple. Now, I will say, simple plans are far simpler than 401k plans. All right. With simplicity, typically comes less flexibility, meaning you have a set of rules you have to follow. If you follow those rules, then you're good to go with your tax treatment. And if you don't, then you got a problem. If you want some more flexibility in how to follow the rules, then you have to set up a 401k plan, and if you have to go through all this documentation and show that you're still following the spirit of the law, if you will, even though you're not doing exactly the requirements, then you can have more flexibility. But there is a far higher threshold in terms of determining that than if you just have a simple plan. Okay? So why would an employer want to have this? Okay, specifically, when you're talking about employer-sponsored retirement plan, there has to be some benefit to the employer. So what happens if they're properly set up, and any of those we listed would have this, say, as long as they follow the basic rules, okay? They get an immediate deduction for contributions, all right? So money they put into the plan for their employees, okay, are deductible to the employer. So I get to reduce my taxes as the business, and the employee does not actually receive compensation. So they do not have to pay tax on it right now, right? They're going to pay tax on it when they withdraw it after retirement down the road, okay? And it's just as important is once the money is in the plan and held by the trustee. Remember, the trustee is the one that actually supervises this, not the employer, not the employee, but rather the trustee has the account, has the money, and they invest it, and it makes interest or dividends or capital gains. That is not taxed to anyone at the time that it's earning that interest while it's in the plan. Now, when you pull that out as an employee, then it's subject to tax. But while it's in the plan, so the plan can grow without causing there to be a tax implication. Okay, so the earnings are not taxable to the employee until withdrawn, and we'll have rules about when that withdrawal can happen and that sort of thing. Some more definitions. Defined contribution plans. This is by far and away the most common plan that is established today, is a defined contribution, which means the employer promises to put a certain amount into the plan each year now. Okay, some percentage of income of the salary of the employee or something like that. They do not promise that they're going to have a certain amount at retirement. All they promise is we'll put the money in, and now it's up to you to make the investments, choose the investments, and make enough so that you can have something when you retire. A defined benefit plan is an actual promise by the employer that when they retire, there will be a certain amount of benefit that they'll be able to get. So you might have heard this was more referred to as a pension. And pension plans require the employer to actually promise a certain amount. So now the employer is responsible not just for putting money into the plan, but also managing all the investments, overseeing the investments that are held by the trustee to make sure that you earn enough to provide them with that benefit when they retire. You can see why that has become less popular for employers, because there's a lot of responsibility there, and an employer that goes bankrupt or something like that has a real hard time fulfilling that obligation. Where if it's a defined contribution, the employer puts it into the plan and goes bankrupt, it has no impact on the plan or the ability that the employee still has the money. The account is still intact and can't actually legally be touched even in bankruptcy. So you're not worried about that. But in a defined benefit plan, there's an obligation there, and companies bankrupt can't fulfill it. All kinds of things get fought over in the bankruptcy court in those situations. Okay, it's not pretty. So what do we talk about when we have a qualified pension or profit sharing plan? So you'll see that there's some limits, there's some rules that allow us to have this tax benefit where the employer can make a contribution, deduct that contribution, but the employee doesn't receive taxable income currently. First of all, it has to be non-discriminatory, which means we can't pick and choose who we want to have part of the plan. We have to open it up to everyone. Now, there are some basic rules we can do. We can basically say, if you haven't worked for us for more than 6 months or a year, you're not part of the plan yet, okay? But that has to apply to everybody, whether they make lots of money or little money, they still have to wait a year, or we have to let everybody in at the same time, okay? And you can't have it more than about a year typically, okay? No matter how complicated your plan is. So that's the first thing, non-discriminatory, has to be for everyone. Minimum vesting rules. Certain plans allow you to, if an employee leaves the company, part of the plan stays with the company. Now, it doesn't go back to the company, the business itself. It's shared with the other participants in the plan. Okay? So if there's 3 of us in a plan and somebody leaves, all right, part of what they have in their plan for them goes with them, and part of it stays in there and becomes owned by the other 2 in the plan. That's the concept of vesting. The part that goes with the employee when he leaves is what's called vested, and the part that doesn't is not vested. Now, a plan can be 100% vested, meaning that immediately, as soon as you put money in, that can be taken with you if you leave the company. But many companies like to have some kind of poll to say, well, if you leave, then you can't take it all with you. And so they have vesting rules, which means they vest, or they can't take it all with them if they leave after 1 year. They can't take it all with them if they leave after 2 years. They have to stay maybe 3 or 4 years, and then then it's all vested and they could take it with them. So kind of keep employees around. But you can't get too carried away. You can't say 10 years before you're vested. There's rules about how that vesting has to work. And then the concept of contributory versus non-contributory. If the employee puts money into the plan and the employer, that's called contributory. If the employee does not, and only the employer puts money into the plan, that's non-contributory. Okay? So, and then we also have some restrictions on the total amount. In a defined contribution plan, you can't have employers putting any more in than $58,000 in 2021 or 100% of compensation. And a defined benefit plan, remember, that is measured based on what benefits do they get at the time of retirement, cannot add to in benefits more than $230,000 at the end of their into retirement. Okay, so you can't put more into the plan than that would result in that kind of benefit. All right, so those are some limits you have to live under if you are want the rules to apply and get that tax savings. So a couple that are more specific, all right, 401k plans must meet non-discrimination rules. That's the hardest thing about a 401k plan, is the non-discrimination rules are very specific. Okay, you have to do all kinds of testing to compare what highly compensated employees put into the plan versus low compensated employees, or the whole plan can become not have the tax benefits. Okay, so it has very specific non-discrimination rules and testing that become very onerous for employers. So there's your maximums the employee can put in. Remember that other employer, this was the employer put in, but employee can defer up to $19,500, and that is extra if you're over 50. Okay, KEO plans are for self-employed. Okay, but they're sort of complicated compared to a couple of other self-employed plans like a SEP, Simplified Employee Pension. This is as simple of an employer plan as you can have, although there are such thing as a solo 401k that are relatively new and can be done if you are one person in your business. But the Simplified Employee Pension, it works basically the same way. Okay, basically, as you're the employer, you create a IRA, which we'll learn a little bit more out later, that type of an account for each employee, and then you put the money in there. The employee does not put any money into it. So this is a non-contributory plan. It is only the employer. Okay? Can't put any more than 25% of compensation. And the most that you can consider for that compensation is $290,000, or you can't, or more than $58,000. All right. So, and see, you can't put anything in. If you're self-employed, if you have Schedule C and you have your own business, you can set up a SEP like this for yourself and put in those limits, okay? Although if it's put in for yourself, it's only 20% of compensation because of the calculation of self-employment tax. But if you want to put in for yourself, you have to, if you have employees, put in the same thing for everybody else too. So if you don't put anything in for them, you can't put anything in for yourself. And so you're stuck doing this for everybody. And there's only a couple of types of situations where you can exclude people if they make less than $600 a year or something like that. And it's really, meaning basically you have to cover everyone. Simple plans were kind of a compromise. Okay, you create an IRA or a 401k for each employee, a simplified 401k. And you don't have to worry about non-discrimination testing and all that calculations if you follow these percentage rules. You match contributions of 3% for all employees. But you can't put anything in unless they put in. So the employee puts in money, you put in, okay? You can match it, but only up to 3%. Or you can just make it a non-contributory plan, so they don't put anything in, and you put in 2% for everybody. So notice you can't put anything more. That's not a lot, okay? So it's 2% for all eligible employees. And the employee, the maximum, okay, that they are allowed to put in is $13,500 with an extra $3,000 if they're over 50, okay? So a couple of questions to check and see. What we know about this, qualified pensions are either defined benefit, okay, which means they promise a certain amount in retirement, or contribution. All they promise is how much they're going to put in now, okay? Qualified pension plans usually don't have employees make contributions. Usually it's the employer is the entire contribution, okay? Contribution for 401k for under 50 is 19.5. Remember, you can put in more if you are over 50, kind of like a catch-up. If you didn't do it until you were 50, you can catch up with additional contributions. Self-employment plans include KEO plans, and a simple plan can only be used by employers with less than 100 or fewer employees and don't have other plans, that sort of thing. That's where the simple plan comes in. They have become fairly popular. They make it relatively painless, meaning you don't have all the paperwork, but you can. It's a very definitive plan that makes it something you can offer to employees and help them understand, that sort of thing.